What's up, guys? Another Trade Genius podcast here with Bob and Phil. Guys, they're trying to save everyone except you. What are we talking about? Well, we're going to get into it, but basically, short-term gain for long-term pain. Let's dive in.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Okay, Bob, so we've had some interesting developments, and you got to look under the hood here. This isn't something you're going to read in the headlines, but can you start off by explaining to us, based on what we've been seeing from the Fed in terms of the Treasury auctions, what actually might be unfolding here? And it's something that you and I have alluded to, I think, last year in our videos about the new normal that's coming.
Yeah, and thanks for you to alerting me to it, is that the Fed has been out of the bond market because they've been trying to get these yields up. But now they're at a point now where it's actually causing significant harm to the stock market and also to the economy and also to the ability of the federal government to borrow money. So yesterday, the Federal Reserve came in and actually bought bonds, but they bought bonds at the short end, which are the T-bill rate bonds. Those are the ones that Yellen's been pumping out. If you want to throw that chart up there, oh no, yeah, you can throw that one up there. But the other chart we'll talk in a second is that she's been pumping out these T-bills because she wants her cake and eat it too. So she wants the money from the borrowing, but at the same time, the banks don't have to post that as collateral against their balance sheets. They can actually speculate with it. And if you can see here, we blew through what they've normally like to keep in terms of their percentages, and she's at max. So it's kind of interesting to me that they're buying these short end bonds, and there's a word out there for it. And guys, get used to this word because it's called yield curve control, or other people call it financial repression. And a lot of people smarter than me, maybe not smarter than Phil, but smarter than me for sure, have been calling for look at what happened in 1940s financial repression. Lynn Alden has been one that's been kind of leading that one. She's a great follow on Twitter, by the way. And she thinks that the government's going to have to engage in a cap on how much interest rate that you can receive from the bond market. And when they do that, they're basically, during World War II, they didn't let you spend money either. So if that didn't happen, we will start getting inflation. And people have been noticing, Phil, gold and silver, and then yesterday, Bitcoin, they're starting to sniff this out.
Right.
And people are starting to say, if you're going to financially repress me in terms of interest rates I can receive, I have to opt into other assets where I can gain advantage. And I think that's why energy has been strong all year. Then I think we're going to actually see that flip, barring a war. Going into recession, I think maybe money's going to slide from energy into precious metals, energy into Bitcoin markets. And I think we're going to see some really interesting moves here. But yeah, for sure, you can see it. And we'll get a short-term pop in the market, Phil. That's why short-term gain. So when people sniff this out, they're going to like, okay, great. The Fed's on our side. They're going to start dropping interest rates, and they're going to try to then reflate the stock market. That's only going to go for so long. And then people are just going to realize, oh, shoot, I'm in a recession. There's no cash flow in these companies. And they're going to be roaring right back out of it again and into safe havens. And then that's when those guys are going to be able to capture really good money in the bond market, because the long-term yields are going to remain higher, Phil. And that means it's going to be easy money for the banks, easy money for high net worth investors, and for people like you and I to jump in on TLT and be able to lock in and just ride out the next 12 to 24 months of, I think, economic pain. What say you?
Right. So I think very important to monitor the flows in TLT if we start seeing those institutional orders hit, and then we start seeing a response bonds from TLT. We had a pretty decent candle on it yesterday on good volume. So there could be some, I haven't seen the evidence of institutional orders yet, but we're going to keep an eye on it because I think that is probably the next thing that you're going to be watching. And it's interesting too, this yield curve, pseudo yield curve control, right? But basically letting the banks buy the long end now. And that does two things. One, it dollar cost averages their horrendous bond position, right? Because the face value of their current bonds is so far underwater to the tune, it's trillions of dollars across the board. So they can dollar cost average that position down, and they can also get these really ripe yields. So it kind of bails the banks out at the same time as also driving down the front end of the curve. Now, that being said, T-bills on the surface, a lot of T-bills being issued, and especially if the Fed's going to sit there and gobble them up, on net is bullish in the short term, like you said, for the market. Why? Because T-bills end up being collateralized for leveraged bets in the market. And that's what happened ever since June on the debt ceiling raise, because Yellen did almost strictly bills, which is very abnormal. But that's why we had the move that we had primarily, in my opinion. So there is going to be a short-term effect of that. However, if you guys look at the yield curve, when the yield curve normalizes steeply, that's essentially what you're going to get in a recession trade. And so from here on out, actually, when we hit par, and we're getting there quickly, a couple more weeks, we're going to be par on the 210s. That's when I say you basically mark off on your calendar, recession started here. And then, you've got, in this situation, I think you got a window maybe about 8 months at least for recession. And really the markets, the markets are not the economy. So where the markets bottom might be, depends on which quarter, right? But maybe it's Q4 of 2024, maybe it's Q1 of 2025 or later. It really depends. But something like that, I think, has a high probability of playing out. And every time we progress, seems like, Bob, week after week, we see more things lining up with that recession trade. The long end of the bonds gets bid, yield curve steepens. We're seeing slowing growth in the economy. And, you still have people denying that a recession is even a reality. In fact, the Fed the last couple of times has removed the word recession out of their talking points, and the market's been down ever since. So they talk about recession, the market goes up. They remove recession, the market goes down. And I think what they don't tell you is probably the one thing that they worry about. So there you go.
Yeah, and hey, Phil, jargon alert. So when Phil says the 210 being at par, what he's saying is that the 2-year yield on the bond, the interest rate, is going to be the same as the 10-year yield on a interest rate. And when he means par, they're going to be even with each other. And when that happens, is that usually signifies the fact that in the past, that's the recession alert trade when those things normalize. So that's what we're watching for now. And then we'll see maybe the whole entire level of interest rates kind of sink like they did when they did the financial repression in 2008, 2009. But this time, just like then, whenever the government tries to fix interest rates, gold and silver, and now we have Bitcoin, are going to like it. Okay. They're going to like it a lot. And oil's been going up with interest rates. So it's going to be interesting to see how oil holds up, if it's going to have a more of a fundamental view or a correlation view. So we're watching that. And the last thing I'm going to say, Phil, there's going to be one important date a month you guys need to watch out for. It's not the unemployment report. It's going to be the Fed issuance report at the end of every month. Okay. That's the one you're going to have to watch out. What are they going to issue in terms of bonds they want to sell? And then obviously every 6 weeks, what are they going to do with interest rates? Those are going to be the drivers of the market. Okay. And that's what's going to tell us. So when you hear people talking about a Santa rally, people thinking, hey, maybe second week in November into Christmas, maybe even to January, we may get a bump. It's going to be all predicated upon what happens on the end of the month in October with that report. And then what happens with the Fed meeting. I'm not sure exactly what day it is. And then from there, if it looks like they're going to repress rates, then you'll get a rally. If they don't repress rates, the fundamentals are bad for businesses. We could keep falling. So that's our caveat. We could have a massive rally here going into from Thanksgiving into Christmas, or they don't do it, and then we're just going to kind of keep diddling down like we did in 2001, 2002, until the market finds a lower level. So that's my view on it, Phil. I think that's what I'm watching for. I'm still net short going into next Friday, but I'm certainly going to watch that report. I know you're going to report it to us, and that may change my view. If I see a lot of T-bills, I don't see a lot of T-bonds being offered, then I'm going to quickly move from a bearish position to a short-term bullish position again until we look at it again in December.
I agree with you. That is the primary driver right now. that will tell you what our net liquidity flows will do. And that way you kind of have that in your head. Obviously, you need to see the trades execute and all that stuff, but your general bias should be correct. So yeah, the quarterly refunding announcements, we had one in August. And now we're going to get one here at the end of this month. And yeah, we'll talk about what we think is how that's going to push the market, because it's very, very reliable in that situation. This last one in August said heavy bond and note issuance. And sure enough, we've been down since August. So really important stuff. Guys, thanks for watching. Bob, thank you so much for that info. Please hit like and subscribe. Check out our specials over at tradegenius.co. We'll see you guys on the next video. Take care.
Trade Genius.